Hi guys, this is Kearns again. This is the lesson 2 of the crypto swing trading class. In this lesson we're gonna make a overview of the market. We're gonna lay down some very important point terminology. We're gonna talk about very common words, and we're gonna kind of help you speak trading and kind of understand what you're doing. Because if you want to get into this business, because it is a business, you need to know what are we talking about. So remember, it's an overview. We're not gonna go into very details, and I strongly recommend, and I always encourage people to do their own researches. Get into the just don't use this class as a backbone in order to find information that is extremely important for you to help you make better decisions. We're gonna start by some basic definition. We're gonna talk about market in general. Now, what is a market? Now, this is a definition that I found on investopedia.com. So I'm gonna read it. The financial market is a broad term describing any marketplace where trading of securities, including equity, bond, currency, derivative, occur. Some financial markets are small with little activity, while some financial markets like the New York Stock Exchange trade trillions of dollars of security daily. Okay. Now, there is a reason why I start with this definition, because it's scary if you don't know nothing. This is what is important to start by talking terminology and have a deep explanation. If you read this definition, there's a bunch of words that I've been using in this definition that is just basically they're telling you, if you're a beginner, get out of here. Well, let's make it very simple. The market is where people they are here to make money. That's the simple word. We are here to make money. Now, what I want to explain, and I am gonna pull out the okay, so let's go on the let's go on the whiteboard. In some ways, like I used to say to my students, we are all traders. We are giving something in order to get something. So whether we are teachers, physicians, lawyers, and maybe you work in 9 to 5, you are trading. So maybe you are giving away your time. You're trading time. Okay, and then you give your time, and then someone give you money. Now this is a form of trading. Okay, so as soon as the economic structure is designed like this, we are all traders. Some of us are conscious, some others are not conscious of this. Now, because of the fact that we are all traders, we will have to introduce the concept of value, and then in the other side, we're gonna have the concept of need. Now, this is the common dialect, this is the common word that they use, but in the market we specifically talk about offer, and then in the other side you have demand. I'm trying to make it simple. Now it's pretty simple. Now this very complicated definition that we just read, it's just this is as simple as I can get it. Someone, maybe you are in this side, you are the one giving in order to get something. Maybe you are the one selling, or maybe you are the one who need some kind of product. It might be a product, it might be a service or an asset, whatever it is. If you have the money in your hand, you're ready to buy, you are in this side. So your time, for an example, you might be in a $10 an hour job. Now your time, the value of your time is 1 hour for $10. Now in order to increase that value, you might need to increase your level of knowledge or experiences. For example, if you've been doing what you're doing for years, maybe you get some kind of promotion and you get paid more. Let's say that you get more money for that. Or the other thing you can do is that you get more knowledge, you get a degree, and that same hour, that same lapse of time, same hour, now move from $10 to, let's say, $20 or even $30. Now this is, you are the same person, you just increase the value, and then same transaction, you are trading time for money. Now in the financial market, we might be trading something else. If for an example, great majority of this class is all about stock and cryptocurrencies. We are trading assets. We are trading assets for money. And then down the road, we're gonna explain where we as traders are important for the market and why it's important for us. Why we come with our money, and then we have the right to get a certain type of reward because of the activities that we are doing in the market. Okay, now there is different type of market. We just talk about the definition, the complicated one, and I tried to make it a little bit easier for you. But there's different type of market. You have the stock market, crypto market, different derivatives market, real estate, and way more markets. Generally what happen is there's a bunch of transaction between people who think people who are buying and who are selling. Now in this class, 50% of the class, we're gonna use a lot of pictures, a lot of illustrations. Now a lot of those illustrations, or 50% of those illustrations, are cryptocurrencies, and 30% of them are stocks, and then we're gonna go over a different type of them. Now some people will say, well, why do I supposed to consider that as a business? Or what is it, a trader? What does that really mean? Remember, the key word here is trade. We are giving something and we are expecting something else in reward. Now I'm pretty sure that you are famous with the 90 and something percent. Most people fail in this business, but the truth is, whether you are a good trader, whether you are a bad one, I don't know where do you situate yourself, we are all here for the same reason. And some people, they are here, they are making money, they are keep making money. Some others, they are losing money and they're still trading because they are share the same hope. They are here to get some reward. They want that money. So in general, whether you are trading in whatever market you are trading in, you are trading in order to get more money. Now, why? For an example, we know if you went to engineering class, you get paid $50 and something an hour, up to 100 and some, depending of your experience, you have the right to get that money because of what you put on your studies, the amount of years you spent in class, all these kind of things. But as a trader, you only come with your money. Why do you have access, and why is it about that you have the right to make money? Because theoretically, the amount of money you can make trading is unlimited. Now let's go over this, and then we're gonna have to go back again on the whiteboard. Let's go on the whiteboard here. Okay, let's reset. Okay, now I'm gonna use a very simple illustration again, just to make you understand what is it and what we are doing. Now I am gonna try to explain that using a story. Okay, we're gonna imagine that the world is not what we know today, without all the technologies and stuff. And this side, and in the left side of this whiteboard, we have a farmer. Okay, and this farmer is producing whatever it is it's needed in the market. Let's say that he's creating that product, which is the product A. This is the product A, the product. Now the production of this product requires some very specific characteristic. It takes a certain time to make that product. We're gonna call it a time frame. Okay, we're gonna call it a time frame of, let's say, 1 year. And then we have the time frame T. And then this farmer is asking for a price for this product A. So he want, let's say that whatever it is, we're gonna take the example of sugarcane. We're gonna take sugarcane. Okay, so his product is sugarcane. And he want is sugarcane. We're gonna use very simple numbers. They are not real numbers, but let's say that he is asking $10 for his whole production for the year. Remember, so sorry about the writing, but that's $10. That's $10 right here. Now that's not $10 we ask, but just illustration. He's asking $10. He's asking $10 for the year. So we have the farmer. His product is his product is $10, and it takes them 1 year. Is asking $10 for his product. I mean, he did some kind of calculation, and he thinks that he deserves $10. Now, because he is the one producing, he's ready to sell. So we're gonna use the red ink, and then he is selling. He's driving all the way down to the market where all the transactions are happening, and then this is where he is gonna sell his sugarcane. Okay, now he's the seller. Okay, now when he made it to market, there is money waiting to buy his product. This money is the expression of the needed in market. We don't know. Anything can affect the demand. We call that the demand. Anything can affect this. Maybe this year people had more need in sugar or alcoholic product, whatever it is. Maybe there is some kind of war, and people need more sugar. It's a well-known story. Now people, they are here, they are buyers. So we're gonna use the like here, and here we have buyers. And this represent the, remember, this the right side of this represent the market. Okay, so it's driving all the way down to the market, and the buyers, they are ready to offer whatever the seller want to give away his product. So they want the farmer want $10, the buyers are ready to give $10. They are ready to buy $10 because they think that the product deserves $10. Okay, that's the first scenario. But let's say that the buyers, sometimes they think that the product deserves less money than that. Okay, so let's say that the buyers, they say, you know what, I am ready to give $5 for your entire year of working. Now, what's gonna happen is that the buyer is ready to is offering $5 for that same product that the farmer think is evaluated at $10. What's gonna happen is there will be some kind of moment in which they will have to negotiate, and maybe they just have to wait. Maybe any factor can trigger one of the actors. Any factors can change their way of thinking. For an example, maybe the farmer, after driving all the way down to the market, had enough money to spend in the market, and for like a couple of weeks he has to go back and feed his family. So maybe he's ready to give a discount. Maybe his price might go down to $7 or $6, or I don't know, maybe. Or maybe that's in the farmer side. Maybe something happened in the buyer sides. Let's say that for some reason there is some more need of sugar cane, or maybe there is a huge demand that they didn't expected, or natural weather, storm, hurricanes, whatever it is, just ramped up the need for sugar cane, or just ramped up the need for that particular product. The reason why I called the product egg is because this is not specific to sugar cane. We all know that the need for gas, for an example, it's more when there's a hurricane. If you want to sell gas and make a profit, you just have to wait that there's a big storm or a big hurricane. The price will go up because everybody is buying to save. They might not need all that gas, but they need it just in case. So any factor can change the buyer side, and any factor can change the farmer sides. Okay, now, because the farmer is here to sell in the market, we call those people bears. Okay, they are bears. Okay, bears, they action in the market push the price down because they are here to cash out. They think that they have something valuable in their hands. They think that it's time for them to get their rewards. They are here to sell. You might heard the terms like dumping in the market, dumping stock or dumping any kind of coin, because some people with a huge bag, he was holding, and then now he's ready to sell, and his action create that his action caused the price to go down because he's here to sell. And the other side of this same picture, the buyers, the people who think that the product is more valuable, or the people who think that the product is needed, these in the market are named the bulls. Now, when I was first exposed to trading bears and bulls was total. The reason why I started that low is because I didn't know nothing about that, and I finally understand. Those people, they think it's a good price to buy. Now their action or their decision can be affected by absolutely anything, and you need to keep that in your mind. Whatever the side we are talking about, their action are affected by absolutely anything. It can be a sentiment, it can be a stupid news, fake or maybe truth. Whatever it is, it can affect. It just need to be a fact or an element or an event big enough or and that can influence decision one side or the others. We're gonna have a lot of illustration about that. Now that is a very simple way to represent the market. Okay, these are people who really need it, they really need to buy. These are people who are really need to sell, and then this is time T. I keep that blank because I'm gonna need this down the road. Now, where are we exactly as traders? Now, there is an action. I forget to put this. There is an action. This is the simple way of representing the market. The bulls, they are buying, so they are selling. They are expressing that green power, if we can say it like that, in order to answer for the bear demands. Now, the reason why I took the time to draw this is because it's very important to know. You will hear that so often in the market. Some people, whatever the case might be, they say, I am a bear, buy a car, or I'm a bull, buy a car. The truth is, if you are a trader, you are neutral by car. You are here. All right. Now, if you are a trader, there's no such of thing of I'm a bull trader or I'm a bear trader. The market decide. Are you with me? If you have a trading account, you open a trading platform, you put your money, I'm gonna try to explain to you why you must be and always be neutral in the market. You react to the trend. For an example, I might be buying the entire year, and the next year I might be selling only. It really depends. Remember, we are here and we are essentially talking about swings. We are here for swing trading. Now, the market decide the trend. You as a swing trader, you're more trend follower. Like I said, as a trader, you cannot have any predefined side in the market. You are in the middle. This is the best position. By having this neutral position, this gives you the right to claim profit or a reward. Now, the question is, why is that, and why a trader has the right to claim money? Why do you make money by being just being in the middle of the market? How do you make money as a trader? Okay, as a trader, you are supposed to be in the middle. You don't have any side, because what is it is you're gonna use some analysis. Some traders use technical analysis, some others use fundamental analysis. In this class, we're gonna talk essentially about technical analysis. We use certain type of analysis to understand which side is the one winning, which side is in control. When the bears are in control, we call the market, we say that the market is bearish, because there is a huge supply, there's way more to sell than to those who want to buy. And when people are more buying, we call this a bullish trend. Now, anything can give the power to one side or the other. It can be any type of event. It could be any time of national or natural stuff. Anything. In some situation, especially in cryptocurrency, it can be any time of news. Doesn't have to be. It can easily be any kind of fake news. But the thing is, as a trader, you're gonna use technical analysis, which is gonna be your main tool to identify which side is in control. And as a swing trader, you're gonna follow the trend. Now, swing trading requires a lot of patience because you cannot be wrong about the trend when you are a swing trader. It can be sometimes some other trading style. They go, for an example, they're not here to stay in the market. As a swing trader, it's very important for you to develop skills that helps you understand and sharpen your trading strategy. Now, why is that? The second point about this class is why traders make money. Why can we claim that money? And it's very important. And then we're gonna have to go back in this figure, because this figure we're gonna use it a lot in the class. We're gonna change information at different point, but we're gonna use it a lot. Now, the trader, it's important because the farmer, when he come with his product, whatever it is he's selling, it might takes them 1 year to complete the cycle of his deal. So we're gonna put 1 year. 1 year. So he has planned, and he can only expect $10 per year. Now, he think that his product is worth $10. The market is the entire thing is the market, but in the bull side, or the buyers, or the customers, you can call them whatever you want. They can have different names. They think that the same product A is worth $5. Now, as a trader, when you come in the market, the first thing you bring when you come in the market is money, because we're not here to buy or use. So often we're not here to use anything, and so often we don't create we don't produce anything. But what is sure is that we often come here with money. Now, let's say in this situation, we come here with $100 in the market. Now, before we came in the market was worth roughly $10 in the bear side and another $5. So in general, there is $10 of product available, and there's another $5. The bulls might have more to buy. They might have more money than that, but they might only have $5 for that specific product. They might have $5 for something else, but that's what they want to put on the table. So before you came, the market was worth $10 from the bear side. That's what they think, because the reality is the value of almost everything in the world depends on what people believe it is. So there is something very particular about gold, because the Native Americans, they didn't care about the gold unless when the conquistadors they came. So the value of anything really depends on what people thinks about it. Now, it's $10 not because there is something intrinsic about the product A. It's $10 because the bears thinks it's $10. So theoretically, the bears create a $10 value in the market. And now there's another $5 in the market, which is the bull belief. This is the expression of what the bulls believe. And now we traders, that's what makes the difference between the 3% that are make money and the 90% that are not making money. We traders, we don't come in the market with belief and emotion. We come with real money. So we show up in the market, and our color, I'm gonna use it, is purple. Purple because we don't have side. And this is real money right there. Okay, so before we came in the market was worth $15 for 1 year. Down the road, we're gonna use T as the main way to express what we call time frame. So the time frame varies based on what type of trader you are. Now, when it comes to the value on the market, we are back in this discussion. Because we come in the market, we add a total of, this is considered a total of $115 value. Now, remember, this guy is here to get his $10, and this guy, the bull, is only, he really want the product or the asset, I don't know, he really think it worth something. But you, the trader, we are here to make money. Now remember, here the reason why we have more money is because so often traders in trading, I mean the traders, there's different type of them. So there's investors or traders. So in trading are traders, they are traders, different type of different styles of trading. Now that's the reason how we have more money, because in this simple word, I am here, you are here, banks are here, different big institutions are here, hedge funds are here. That's a lot of money. But eventually, we are not here to use the product, and we are not certainly here to satisfy the customer. We are here for only one reason. We are here to make money. Now, if we actually believe that this product worth something, or if we think, we do some kind of analysis, and then we came with the idea of the theory that, well, this product is about to be extremely rare. For an example, when there is rarity of fuel in the market, like, I think I'll talk about that. So for some reason, we can express our buying power at that moment, because we think that the product is essentially worth more than just $10. So we think that the bulls are in control. Traders, we express our bull power toward the farmer, but we're gonna have to talk to him and propose him a deal. The deal that we're gonna have to propose him is, we're gonna buy your 1 year worth of product, and actually we're gonna buy 2 times more. So we're gonna buy for that year and the next year. So we establish another relationship between you and the farmer or the bear, because we're gonna have to change all those nomination down the road. So now we go ahead and buy his product, not just 1 year, but 2 years. So suddenly what happened is, our simple action create this wow. Suddenly this simple action as that we do in the market, there's just not enough product available. So we kind of take control of the real value of this now, because we think, so we buy from this farmer, we offer this deal to this farmer, that particular farmer, or to the entire network of farmers, and we said that we're gonna buy everything. So suddenly we are buying everything, and then we are willing to sell, because we create that that lack on the market. We create that gap right there. See, we create that. Just our action just create that. And then that product was $10 worth, and then we're gonna express our bear power toward the bulls. Remember, we don't outside, we traders. Okay, so we're gonna actually, because we do some kind of analysis, for an example, when you go in a grocery store, you don't have an idea of what product you won't be able to buy next week. You don't know which ones we're gonna have a lack of this. We're gonna, for an example, if ever there is some kind of trade war between the United States or any other country, we don't know what kind of product gonna be affected. We just have to believe information that come to us, information that someone can literally buy and prevent us from having. So this, as a trader, we develop skills. We essentially use technical analysis to understand what is more probable to happen in the future. Now, because we create that relationship, we broke that relationship between the bulls and the bears. We came in the middle. Why is that important? Is that, remember, they were having some kind of discussion. They were having, it was very difficult for them to get a deal because he wants $10 and he is only ready to give $5. When you come in the market, we add another $100 value in the market. This is why they say that traders, they bring liquidity in the market. So because we come in the market, we come here and we make the market more liquid. It's literally mean what it say. We just make deal go a little bit faster, smoother between them. And because we create that, we kind of share the risk. That's the reason why we traders, we can claim some kind of reward. Okay, so because of our analysis, eventually, let's say that we did some kind of studies and then we realize in 1 month there will be a certain or in next year we know that something's gonna happen, whatever it is. And some traders, some fundamentalists, they use population studies to make their decision in the market. So we go ahead and then we put a price because we just buy everything. We bought everything. Now, what was $10 switch from being $10 to $20. The bulls, now they have to make some. They have to. In some ways, they will have to take some decision because we take the risk and we demand some reward for it. So in some ways, because we are adding pressure in the market, the bulls will eventually have to roll with us. There is a lack here, and then suddenly we broke that relationship. So I am not saying that there is no relationship at all. It's just that it's not the same way. They don't talk to each other the same way anymore. We broke that relationship. Now, this is very this is the type of thing that happen very often, and even in this kind of things, in some countries, the traders, they have different names. They have different type of power. For an example, I'll give you an example. In Canada, maple syrup is a well-known product from this country, but there is an association. They make sure that the price stays stable. Now, what they do is they create some kind of network in which everybody who is producer of maple syrup, they must be part of that. How do they call it? It's an association, and then the association regulate the amount of product that is being delivered in the market. So anytime there is more for the year, they save a certain quantity. Let's say that they only want 1,000 barrel per year, 1,000. Okay, so if there is 2,000 produced this year, they save 1,000, they only deliver 1,000 in the market. And when there's less than that 1,000, they use the reserve and then make sure that they keep that same production of 1,000 of barrel of maple disease per year. That's an example. The reason is this simple way of managing the product on the market keep a stable price. It's very now because of that, it's very regulated, and also help when it comes to counterfeit to be easily identified. Helps the farmer stay happy, and helps the bulls in some ways to expect what kind of price. We know that the price doesn't really change over the year because of that kind of regulation that people that this association they made it. Okay, so this is one of the way people can just go ahead and make sure that there is that's exactly what we call hiding liquidity. We do analysis, and because of that we demand some reward. So as a traders, we don't make money because I know there's a lot of uncertainty in this business, but it's not that we are total gamblers. We are spending times, years of analysis and sharpen our skills on a daily basis just to make sure that our analysis is on point, just to grab that probability. Now, this is exactly what you need to understand, and that's the reason why as a trader it's very important for you to keep a neutral position all the time. We are very familiar to some traders out there. Well, we can call them traders. They call themselves traders, and then they are obsessed about a position. Let's say that they know that the market is gonna drop. There's no such a thing. We don't know nothing. We do analysis and we evaluate probability, and then when the market decides something else, we quickly agree with the market, and then we act in situation. Okay, now in this explanation, I think that I even cover why we are needed, because like I told you, it would be very difficult. The reason why we are important is because we kind of make transaction go a little bit faster. Now, you see, this farmer, he came in the market expecting $10. Now he get 20. He has enough money to, with peace of mind, he's gonna go home and work hard to produce another certain type of money. Now, this is a situation in which we, the traders, kind of increase the price. In this situation, we literally double it. But the inverse can also be true. Let's say that we are wrong about our analysis. Let's say that the bulls, they don't want to buy it, and then suddenly we have too much product over here. If after the farmers they manage to complete the cycle, if they want to sell and we don't want to buy, they will have to go back and reestablish. They're gonna have to go back and reestablish this whole relationship between them and buyers. Now look at that. There is two bear lines. These are red lines. There is actually two bear pressure. In this situation, for an example, you might have a situation in which price keep going down because there is too much what they call, there's too much supply, because the bears, I'm gonna put it in red because it's important that you get used to the colors. The bears, what they bring in the market, essentially they are supplier. They supply. Okay, and then the bulls, they act on the market by controlling the demand. There's many other ways to say it. After that, I'm gonna explain you the concept of bid and ask when we're gonna talk about the trading platform. So because there is that situation of extreme supply, because remember, as a traders, we are both suppliers and we are both we control demand and supply. We only make action that favorize one side or the others. If there is too much red in the chart, we know that the price is going down. So the truth is, if there is too much selling pressure, we have too much to sell. The farmers, they have too much to sell. The price in this side will go down, and the bulls will probably realize his dream of buying that same project at $5. Are you with me? So technically, this is where we are now. This image, I want you to keep it in mind, because we're gonna use it over and over. We're gonna have to do it again because it's very important for you to go over it. Now this is that's it for lesson 2. Go over it. Remember, guys, to subscribe, share those information. You can go ahead and do whatever you want with the videos. You can go ahead and download it, because it's just an introduction, really. Take care of yourself. Bye now.